Hello, everybody, and welcome back to the Financial Deviant podcast. I think we've got a show that will be of interest to many of you. And I've really been looking forward to this because it's kind of at the heart of what the Financial Deviant podcast is all about. And we're going to call this one Investment Basics. Investment Basics. On my first episode, we talked about how minorities have historically been behind the wall. Historically, we have not had the opportunity, in many cases didn't have the knowledge to take advantage of the investment opportunities in the market, in the stock market, didn't really understand it. Therefore, we couldn't take advantage of it. Today's show, we just kind of want to start the process of demystifying money for those who have been underrepresented. The stock market is one of the tools that people have used for many years to get ahead, to build wealth, to put themselves in a situation where they can leave a financial legacy for their descendants, for their children, for their grandchildren. And, instead of trying to sit there and admire the problem, what I want to do is start to shed some light. We can all sit there and talk about why things are the way they are, but at a certain point, once you gain some knowledge and once you gain the skills necessary, you have to move forward with action. And so again, I don't want to continue to admire the problem. This podcast is an effort to take even a small step towards shedding some light on some information that hopefully some of you can benefit from. Now, let me go ahead and say this from the very top. I am sure there are people out there who have even more knowledge than I have. I am not even claiming to be the expert. But the truth of the matter is, that's why I think I'm a great person to do this. Because one of the things I want to convey is that you don't have to be an expert to take advantage of what we call the market. I'm in the process of finishing up a book. By the way, if you're interested in reading about investing, Jack Bogle who's the guy who founded Vanguard, who's obviously one of the largest investment companies in the world. He was also the first person to come up with an index mutual fund. But I'm finishing up a book that he wrote several years ago called The Little Book of Common Sense Investing. And it's really simple. And, if you have that interest in that kind of thing, it might be a great read for you. Some of the things that I will talk about will actually come from that book, some of the concepts. But again, the fact that I'm not an expert makes me the perfect person to talk about this, because it'll reinforce the fact that you don't have to be an expert to take advantage of what is available. So, what is the stock market? Well, the stock market is basically it's a group of exchanges that allow individuals, organizations to buy and sell shares of publicly traded companies. Now, the power in that has been harnessed, as I said, for many years. And I absolutely love it, because right now there are somewhere in the neighborhood of probably 4,000 companies that are being publicly traded on the New York Stock Exchange. And essentially, we can buy all of it. We can own shares of these companies. And so if you think about it, it's a way for us to be an entrepreneur as an investor. What better way to create passive income for you and your families than to invest in these innovative companies that we see every day, that we drive around in, that we eat, the place where we go shopping. It gives us the opportunity to own shares, to own these companies. And that's extremely powerful. Now, historically, you had to have special information, special knowledge to get access, to even have the opportunity to buy stocks and to buy bonds, and you had to really have this, I'll call it inside information, in order to be able to take advantage of it. But today, with technology, with the internet, I can sit here right in my living room and purchase shares of a mutual fund that owns all 4,000 of those companies, that invests in all 4,000 of those companies. And truthfully, I actually own a fund that invests in the total stock market. So technology has opened up the doors for a lot of us. And I think it's important that we all take advantage of it. When I was growing up, I used to watch the ticker on TV, and I'd hear the guy talking about the Dow Jones Industrial Average. And I'm like, okay, I know it's important, but I don't know exactly how people are using that. So what is the Dow Jones Industrial Average? Well, it is it's basically the share or the stock price of the 30 most traded companies on the New York Stock Exchange and the NASDAQ. So when you hear the Dow Jones Industrial Average is up 400 points, that means somebody is happy. That means somebody is making some money. And if we're in the market, we can be one of those people who are taking advantage of the performance of these companies. So the Dow Jones, the 30 largest, most traded companies on the New York Stock Exchange and on the NASDAQ. Now, there are different size companies that you can invest in. You can buy stocks in a small cap company, a mid cap company, a large cap company, a micro cap, or even a nano cap. So what does that mean? Cap is short for capitalization. If you're investing in a small cap, that's in general, I mean, different organizations have different definitions of what a small cap is, but for our purposes, you'll say it's a company that is worth from $300 million to $2 billion dollars. Sorry, from $300 million to $2 billion dollars. Small cap. You think of companies like Dollar General, General Dynamics, Uber, Capital One, Norfolk Southern, the rail company. Companies like that are considered small cap, and they are historically, they have outperformed some of the other size companies. They're smaller. They're considered generally more aggressive, which means there's more risk involved. That's where that volatility comes in, where people start getting concerned and worried about what the market is doing. So that's small cap. The next one is called mid cap. And mid cap companies are generally from $2 billion to $10 billion. And you think of companies like Facebook, Procter & Gamble, Home Depot, Visa, Walmart would be considered mid cap. And then you move on to large cap. Those are 10 billion or bigger. And that's companies like Apple, Microsoft, Tesla, Amazon, those types of companies. And as I said, you can even go smaller than that. Anything below $300 million is called a micro cap. And then below 50 million is called a nano cap. Those are extremely volatile, risky, kind of like put you on a roller coaster if you're not careful. The one of the biggest points I wanted to make is that individual stocks, picking individual single stocks of any of these companies can be difficult to do. We've all heard of day traders, people who are just on the computer all day long, trying to buy low and sell high. Well, for the average investor, that is not what I would recommend, and that's not something I do personally. If that's the interest of anybody listening, then this is definitely not something you're going to want to hear, because the average person, not even the average person, most people are incapable of doing that well. I don't care what people promise you. Most people are not capable of consistently beating the market, doing a great job of buying low and selling high. That is a stressful way to live. Not anything I'm even remotely interested in. I mean, I have owned some single stocks. I own one or two single stocks right now, but when I say investing, I'm talking about mutual funds or ETFs, primarily. I mentioned the Dow Jones a minute ago. One of the other indexes is called the S&P 500. So an index basically is kind of like the Dow Jones, as I said earlier. The S&P 500 checks or tracks the pricing of the 500 largest companies. And it's weighted by cap size. When I say cap size, whether it's large cap, small cap, it's weighted, but it's essentially it tracks the performance of the 500 largest companies that are publicly traded. And it is just like the Dow Jones, it's an indicator of how the market is doing as a whole. It is one of the things you can buy funds that track the S&P 500, an index fund. It's not trying to beat the market. It is just trying to get its fair share of the profits from the market. Again, picking individual stocks is a very, very difficult thing to do. And most people, even the professionals, don't do it well and don't do it consistently, regardless of what they're telling you. You know, I alluded to the book that I'm finishing up right now. And there is historical data out there that says there has been no one who could consistently over the years beat the market. And when I say beat the market, I mean you will be better off investing in what I call an index fund, like a fund that tracks the S&P 500, or there are funds that track the entire market. They're not trying to beat the market. They're just trying to ride along with the market. And for example, the S&P 500 historically has returned about from 9 to 10% on investments. 9 to 10% consistently. You compared those index funds where there's not somebody actively managing it. They don't have a fund manager. You compare that to the actively traded funds where you got people that you have to pay, and they're trying to beat the market. They're trying to buy and sell and come up with this way to beat the market. And as I said, most people cannot do it consistently. And one of the reasons they can't do it consistently is because when you have an actively traded fund, you have higher fees, and those fees come right off the returns. So be honest with you, even if those actively managed funds had the same performance as an index fund, which is not actively traded, they end up losing because you also have to subtract the fees that come along with an actively traded fund. So historically, that's why I made the point, and that's why I said multiple times, people who say they can beat the market actively traded. I put a post on social media the other day and basically said, hey, friends and family, check your 401k, check your 403b, check your 457b. Make sure that you're only, or give serious consideration, because I'm not a financial advisor, give some serious consideration to being only in index funds, because all you're doing, if you're in an actively managed fund, is giving your hard-earned money away. Keep more of your money by investing in index fund. This is not even opinion. There's some very compelling data out there that supports it. So that's what I do. Again, I'm not a financial advisor. That's what I do, but I do want people to really think about ways to keep more of their money, because again, historically, actively managed funds have not been able to beat just investing in a simple index fund that tracks the market. I mentioned ETF a minute ago, mutual fund. What is a mutual fund? This is the way that I invest. This is the primary way I invest, either in mutual funds or what's called ETFs. They're very similar. So a mutual fund is a financial vehicle that basically pools the assets of multiple shareholders and invests in stocks or bonds or money markets or whatever. They offer the average person access to thousands of companies by making one payment. And I mentioned that a minute ago. It is the way to do it, in my opinion. I am personally not a fan of trying to day trade and buy individual stocks and sell them at the right time, because nobody has proven to be good at timing the market. No, we don't know. People who work to try to time the market are in a rubber room somewhere right now, because it's not something you can do well, and definitely not something you can do well consistently. So mutual funds, again, I mentioned a minute ago that there's one particular, well, let me say this first. So you got a mutual fund and you got an ETF. The ETF stands for Exchange Traded Fund. It's a more recent creation than a mutual fund. So there were people who figured, okay, the mutual fund, you can't buy and sell that throughout the day like a stock. If you have an individual stock, you can just at any point in the day, you can say, hey, I want to sell this many shares right now, and do it. With a mutual fund, you can't do that. It has a price, what I call a price per day. And at the end of the day, you get the price that you can either sell it for or you can buy it for. But an ETF, an exchange traded fund, allows you to trade shares of that ETF just like a stock throughout the day, whenever you want to. Both of these, mutual funds or ETFs, it's essentially a basket of individual stocks. You take all of these individual stocks, put them in one basket, and allows you to invest in all of them at one time. Very cool. Very cool. So I wanted to just talk a little bit there. Mutual funds, ETFs, to me, it doesn't really matter. ETFs are generally considered to be a little more tax efficient. For long-term buy and hold investors, which is what I am, mutual funds are fine. I've owned both. The bottom line is both of those tools allow you to invest in the entire market or segments of the market. How there are several ways to do it, and it just allows all of us an opportunity to take advantage of being involved in the stock market and being invested in a very simple way that we don't have to be experts. So I mentioned a second ago, buy and hold. That's how I would classify myself primarily. I own index funds. I invest in those funds, and I'm buying all these many company shares of many companies as a part of those index funds. And I'm not trying to get in and out on a daily basis. I'm buying and I'm holding. And I heard one well-known pundit make the comment, the only people who get hurt on a roller coaster are the people who jump off in the middle of the ride. What that means is the market, one of the things that keeps people from investing in the market is the fear of the ups and downs, the volatility. It is one of the things, the common things that keeps people from doing it. And that's understandable. That is absolutely understandable. because investing in the market is not just a task that's a physical task. There's a lot of emotion involved in it. But I think sometimes we can maybe make better decisions if our emotions are informed. If all we have are emotions, we may make a rash decision and regret it the minute we do it. But if our emotions are informed, many times we can make better decisions. So what do I mean by that? We know the market goes up and down. That is a given. But so far, I've only talked about stocks, also called equities, ownership. But there's also another key part of most investment portfolios, and that's the bonds. The bonds are essentially loans that you and I can make to organizations. They need to raise money for whatever reason, and they issue bonds. We can invest in those bonds, and they agree to pay us a pre-established interest rate on a certain schedule in exchange for us investing in their organization or buying their bonds. And their bonds have something called a maturity date. That's how long, that's basically the term, how long that bond is good for. And they can range from 30 days to 100 years. Yes, 100 years. There are things called the century bonds. What happens is you give them your money. They agree to pay you a certain interest rate on a certain schedule. And then at the end of the term, at the maturity date, you get your principal back also. So a bond is considered a fixed income tool. And bonds, they are municipal bonds where cities issue bonds because they're trying to raise money for projects or capital projects or whatever the case may be. You can invest in those, and there are certain tax benefits to many of them, the munis, they're called municipal bonds. There are corporate bonds where companies are trying to raise money for whatever they've got going on. You can invest in those. There are treasury bonds. The federal government partially funds itself through treasury bonds. You can invest in those. So there are several types of bonds. And the whole idea is it is considered a fixed and a safer investment because they agree to pay you interest over a certain amount of time, and you also get your principal back at the end. But there's also risk that comes with bonds. A lot of times people don't think about that. And one of the risks that comes with bonds, if whatever the organization is, if they go under, if they default, there's a possibility you don't get your money back. So a lot of times we think about stocks as being the risky one, but bonds, there is some risk in it as well. And in the case of bonds, there's a general rule when interest rates go up, like they're going up now. This is October 2022. When interest rates go up, bond yields or the interest that you earn on bonds generally go down. And vice versa, when interest rates are down, historically the value of the bonds go up. So the bonds are the things that are part of our portfolio that kind of levels out some of those ups and downs. Because it's a fixed income, it's a safer investment, it kind of helps to level out the volatility that comes with investing in the stocks, in the stock market, and the equities. When I alluded a minute ago, I said that, the one thing that keeps people from participating in the market is that fear of ups and downs. One of the ways you combat that is by countering the stocks with the volatility with bonds. And of course, you can also counter it with some cash. But as I said a second ago, when we inform our emotions, we can make better decisions. And when you talk about informing our emotions, think about what I refer to is the historical performance of the markets. Let me give you an example. As I mentioned a second ago, we talked about the small cap companies a little while ago that are from $300 million to $2 billion. And historically, they have outperformed the large cap companies. The issue is, in the process of outperforming, they tend to be extremely volatile, extremely inconsistent. Over time, they've outperformed the larger companies, but it's just a matter of whether emotionally you or me as an investor can handle the ups and downs. And pretty much when you talk to any investment organization, an advisor, a financial planner, they have a questionnaire. And one of the things they're trying to get to is to get an idea of what your risk tolerance is. How much can you tolerate? And to be honest with you, sometimes we think we know what our risk tolerance is until the market starts going down. And then we say, well, I may not be as aggressive as I thought I was. Might better get a little more conservative. And a lot of times that's done by the balance of stocks and bonds. One thing you'll hear people talk about is your allocations. You talk about how much are you investing in stocks and how much you're investing in bonds. And you might hear something like, oh, I'm a 90-10, which means 90% in stocks and 10% in bonds. That's fairly aggressive. Again, because of the volatility in the equities markets. Or you may hear somebody say, oh, I'm an 80-20, 80% in equities and 20% in bonds. That's less aggressive, still fairly aggressive. And what you hear a lot of times, the older the person is you're talking to, the higher that bond percentage will become. You may hear something as a person gets closer to retirement age, they may say it may go more of a 60-40, 60% stocks and 40% bond, because at that age, they're less willing to deal with all of the volatility in the markets. Some people, when they get to retirement age, they're at 50-50. So there are all kinds of things you can do, but the main idea is we don't really know many times what our risk tolerance is until we actually have to go through the storm. And we're in a storm right now, for sure. But I will tell you, I have personally not made an adjustment to my allocation based on what the market's doing now, because the way I see it now is the market is down and it allows me to buy stuff at a discount. So I'm continuing to buy. And when it comes up, I anticipate that I will reap the rewards of not bailing out, hanging in there and continuing to buy at a discount. Again, informed emotion. Informed emotion. Yes, it is difficult and it can be difficult. And I'm not one who tries to talk anybody into anything. This is something that each individual has to consider for themselves, because nobody can tell you how you are going to deal with a volatile market. You're the one, you and I, as individuals, have to decide how much we're willing to stomach or how much we can stomach. And if you're married, how much your spouse can stomach, right? So we have to, and to be honest with you, I spoke a second ago, I think I actually misspoke, because between 1926 and 2022, the S&P 500 has had a return of between 10 and 11%. But during that time, there have been years where the return has been negative. So the question was, when it was negative, who was able to hang on and reap the reward and who bailed out? And I can tell you, I read a lot of forums and there are people definitely who regret times that they've jumped out of the market, sold everything because it was going in the wrong direction, and they regret it today. Again, that's fine. Nobody can be beaten up about that, but it's just we have to, as individuals, decide what we can handle, how much of it we can deal with emotionally. And you think about this, though. Uncle Sam takes his money. If you have a job, Uncle Sam takes his money, his tax money from you throughout the year. He does not trust you to save up money and pay him the taxes you owe him at the end of the year. I think that we need to adopt that same methodology when it comes to our money. We need to be interested and insistent on paying ourselves just like we pay Uncle Sam. That just makes sense to me. Pay yourself just like you're paying Uncle Sam. But here's the thing. One of the best ways you can receive the best returns is to pay off debt. Pay off consumer debt. Think about this. The S&P 500 since 1926 has earned 11.82%. If you've got credit cards that have interest rates of 17, 18, 19, 20, 21%, right now the best return you can get is if you pay off that debt. Think about that. 18, 19, 20% interest, compound interest working against you. If you get rid of that, that's an immediate 18, 19, 20% return on an investment. And then when you get rid of that debt that's hanging over your head, you can turn that money around, invest it in a simple index fund, target date retirement fund. There are numerous vehicles out there that you can use and start to pay yourself and work on building wealth for yourself and your family. The debt can keep us all from being our best financial self. Everybody knows that. So if you we're doing this podcast on investment basics, but even more basic than that is get rid of the debt so that you can participate in this amazing tool that has allowed many people to earn massive passive income. And I will say again before I leave you today, you don't have to be a genius to do this. You don't have to be the most knowledgeable person to do this. The number one determinant as to how many assets you're able to build and grow is whether you actually invest. We can sit around and think about it. We can sit around and think about why we shouldn't. We can ask friends and family, what do you think about it? But there's no question that one of the primary ways that wealth has been grown in this country is through investments in the markets. And I want us to get our fair share. But in order to get our fair share, we have to put aside what we think and educate ourselves. This podcast is just a beginning. Can't possibly talk about all of the nuances of the market. I just wanted to share a few basic things that just to get you to thinking about how you might go about dipping your toe in the water. Don't let the fear paralyze you. Before our next episode, open up an investment account. Open up an account with whoever. I don't have anybody in particular that I could recommend. I have one, but there are so many out there. Fidelity, there's Vanguard, there's TD Ameritrade. There's all kind of ways to do it. And there are robo-advisors, so many robo-advisors these days that you can use. Very simple. I actually set up a robo-advisor account for my son the other day just to introduce him to it. And we set up an automatic contribution on a monthly basis for him. And because I want him to understand that, hey, man, it doesn't take a lot of money at your age. You can put just a little bit of money aside every month and the results be amazing. So there's a lot of ways to do it, but I just kind of dip that toe in the water. Go ahead and just don't be afraid. And once you get into it, you may decide, you know what? This is something I really, really, really need to continue to educate myself on. And you never know where you're going to wind up. And if that's the case, that would be amazing. I would be thrilled if just this little short conversation results in someone dipping their toe in the water. So I appreciate you guys. Do me a favor. Subscribe to the podcast. Share it with somebody you know. We're going to continue to have a lot of fun. We're going to have some amazing interviews, as I've mentioned. And you never know. You may even be on the show yourself. You may do some things, and I may have to call you up and say, hey, would you like to do an interview with the Financial Deviant? So until the next time, thank you guys for being here. Thank you for listening. Again, share the podcast, subscribe so you won't miss anything, won't miss any future episodes. And I will talk to you soon. This is the Financial Deviant saying, see you next time.